Hello everyone, welcome back. In the previous episode, we discussed how Nvidia, because of financing guarantees and the circular nature of AI capital spending, brought clear pressure to the AI chip sector. At the same time, stocks such as Apple, Microsoft, Bank of America, and Chubb became relatively resilient areas in the market. Our judgment at the time was that capital was not leaving the stock market. Instead, it was moving out of high volatility AI chip names and flowing into financials, insurance, and selected large cap technology stocks. Now, the latest market action has given us a more complete answer. That judgment has not failed. It has evolved into a more refined form of layered pricing. This week's market action does not mean risk has been removed. Instead, the market is going through a three-part stress test. First, can AI companies prove that capital expenditure can turn into revenue and profit? Second, will the Federal Reserve and long-term interest rates continue to weigh on high valuations? Third, can cash flow stocks continue to absorb capital during rapid rotation? AI is not over, but the AI sector has already started to split internally. Let's start with technology stocks. Microsoft is the clearest positive case in this round of market action. The market saw strong Azure growth and saw that AI investment had a chance to turn into real revenue and profit. That is why Microsoft surged after earnings and continued to strengthen afterward. This shows that the AI trade is not over. What the market is rewarding now is who can prove that the money being spent can truly be earned back. Amazon follows a similar logic. AWS growth was strong, and the market temporarily accepted the argument that higher capital expenditure could be absorbed by stronger cloud growth. That is why Amazon surged and helped restore market confidence in AI cloud and AI infrastructure. Although Meta still has an AI story, the market is worried that its capital expenditure will continue to expand and that free cash flow will be compressed. As a result, the stock was punished. In other words, simply having the AI label is no longer enough to rise. A company must prove the return on its AI investment. This also makes Nvidia's position clearer. Nvidia's fundamentals have not collapsed, and demand for AI chips has not disappeared. But what the market was previously worried about is this. If Nvidia is both the supplier and the investor, and even has to help customers with financing, then the quality of future orders and the quality of cash flow will be re-examined. Apple's decline adds a key variable. AI cost pressure will pass through to end-user hardware. In the previous episode, Apple briefly reclaimed the title of the world's most valuable company, making it look like a technology safe haven amid AI uncertainty. But the sharp drop after the latest earnings report shows that Apple is not completely removed from AI-related pressure. Apple is facing a different kind of pressure. The AI hardware cycle has pushed up memory and supply chain costs, and these costs directly affect end product margins and future guidance. So our judgment is this. AI pressure does not exist only among cloud providers and chip companies. It can also pass through to consumer electronics companies through memory prices, supply chain costs, and margin pressure. This means Apple can no longer be treated simply as a safe haven during AI volatility. It now needs to prove three things again. First, whether demand for the iPhone and Mac can continue. Second, whether services revenue can withstand hardware cost pressure. And third, whether AI features can truly stimulate the replacement cycle. At the same time, the interest rate side has only had a short breather. The risk has not disappeared. The Federal Reserve did not raise rates immediately, giving technology stock valuations a brief breather. But long-term Treasury yields remain high. Inflation has still not returned to the Fed's target, and oil prices and geopolitical risks may continue to affect inflation expectations. So the current stock market situation is this. Part of the earnings line has temporarily passed the test, and the interest rate line has not continued to worsen for now. But the real valuation ceiling is still there. Regarding the stocks we focused on and suggested watching in the previous episode, we now make the following adjustments. MSFT. Microsoft has received the strongest validation. Based on the suggestion given on the 28th, at least a 10% gain should have been validated. Follow-up suggestion. It is not suitable to handle it with a chase high mindset. If it pulls back to around $450 to $455 and still finds buying support, the continuation of the trend can be watched. If it falls back into the earnings gap area, we need to guard against a good news fully priced in move. NVDA. The follow-up suggestion for Nvidia is that it is suitable as a high volatility core AI watchlist stock, but not as a defensive asset. As long as it can regain and hold above $200, sentiment recovery remains intact. If it falls below $200 again, the market will reprice financing and valuation risks. AAPL. The follow-up suggestion for Apple is not to rush into bottom fishing in the short term. The key is whether it can stabilize around $305 to $310. If it cannot reclaim $320, it should still be viewed as a weak rebound. Only if it returns above $330 will it show that the market has begun to accept Apple's growth logic again. BAC. Bank of America's financial defense logic remains in place, but its upside elasticity is not as strong as the AI winners. The $62 level remains the key dividing line. Follow-up suggestion. Only if it can hold above $62 is there a chance to continue watching $64 to $65.50. If it falls below $61.50, the breakout needs to be reassessed as potentially failed. CB. Chubb's latest validation shows that the defensive logic has not disappeared, but the short-term break below the previous $358 to $362 trading range shows that insurance stocks also cannot be chased blindly. Follow-up suggestion. The area around $350 has become the new lifeline. A return above $353 to $355 would count as an initial recovery. Only a return to $358 to $362 would restore the strong watch setup. If it breaks below $350, wait to reassess around $340 to $345. AMZN. Amazon, similarly, based on the suggestion given on the 28th, should have validated at least a 10% gain. Follow-up suggestion. Do not chase the rally. Instead, watch whether the strength can continue through a full regular trading session. As long as AWS growth continues to outweigh FCF concerns, it can still serve as a positive sample for the AI cloud chain. Meta did not pass the current stress test. For now, it is not within the scope of consideration. Therefore, the core conclusion for the content going forward will be upgraded from defensive stocks have been validated to the market has entered a layered stress test. Our thinking from here is AI is not over, but the AI sector has begun to split internally. Second, Apple is no longer a simple technology safe haven. It is facing high memory prices, supply chain costs, and weak guidance pressure brought by the AI hardware cycle. Third, defensive stocks still matter, but they cannot be chased blindly. BAC still needs to hold $62, and Chubb needs to regain and hold $350. Only a return to key ranges would show that defensive capital is still present. Fourth, Nvidia's risk may ease, but if customers continue to raise capital expenditure while free cash flow deteriorates, Nvidia will still face a second round of valuation pressure. Do not blindly buy AI at the highest levels right now. Capital will wait for confirmation among AI, financials, insurance, and cash flow assets. If a stock can continue rising on strong volume after good news, that is real strength. If it does not rise after good news or even falls on heavy volume, that is a risk signal. This episode is for market analysis and risk warning only and does not constitute investment advice. Before investing, please make independent judgments based on your own investment horizon, position structure, and risk tolerance.